Most investors watching this already own Parikh flexi-cap fund. And if you're honest with yourself, you have felt this at least once. The market is flying, headlines are screaming 20-25% returns, your friends are sharing screenshots, and then you check Parikh flexi-cap fund returns 13%, 14, maybe 15%. Not bad really, but not exciting either. So the doubt creeps in. Did I choose the wrong fund? Why is this fund always late to the party? But the truth is, Parikh isn't trying to win bull markets. It's trying to make sure you survive the ones that matter. And that's exactly why most people misunderstand it. Investors assume every equity fund is playing the same game, same rules, same objectives, same finish line. But the truth is, they're not. When you compare Parikh to funds delivering 20-25% in bull run, you're benchmarking it on the wrong parameter. Those funds are optimized to capture momentum. They stay fully invested, they ride the high beta stocks. They benefit the most when liquidity is abundant and valuations stop mattering. Parikh is built for a different job altogether. Its mandate is not to look good in any one particular year. Its mandate is to compound capital across full market cycles. That distinction matters more than most people realize. Bull markets are loud, they reward aggression, they make risk invisible. Almost every fund looks smart when everything is going up. That's not really a skill, that's the tide. The real test of an equity strategy is not how much it makes when the market rises, it's how little it loses when the markets fall. Parikh accepts upfront that this choice has a cost. In euphoric phases, it will lag, not because it cannot do better, but because doing better would require abandoning the very discipline that promotes investors when cycles reverse. And once you see the fund through this lens, the so called underperformance, it starts to make sense. This growth didn't come from hot returns, it came from investors saying put across corrections and adding more capital when volatility showed up. And that's where the real story begins. Capital preservation is not fear, it's strategy. Once you accept that Parikh is playing a different game, the next question naturally follows. Why does it behave so cautiously when markets are clearly rewarding aggression? It's because in investing, the biggest enemy of compounding is not really low returns, it's large losses. This is the principle most bull markets erase from memory. If a fund falls 30%, it does not need 30% to recover. It needs more than 40%. That gap is where years of compounding quietly die. Parikh is built around one non-negotiable idea: avoid permanent damage to capital. That's why its portfolio construction is conservative by design, lower beta, fewer speculative names, no rush to chase what is working right now. The fund managers would rather look wrong in the bull run than be forced into recovery mode after a crash. This shows up clearly in how the fund behaves during stress. When the markets correct sharply, Parikh consistently falls far less than the index and most of its peers. And those smaller drawdowns mean two things. First, investors panic less, and the fund needs far less effort to get back to the previous highs. This is where the misunderstanding comes in. Most investors only notice what the fund did not earn in the bull market. They rarely notice what it did not lose in the bear market. But mathematically, the second matters far more. Capital preservation is not really about being pessimistic, it's about respecting how fragile compounding really is. One bad cycle can wipe out the gains of several good years. PPFAS chooses to remove that risk even if it means sacrificing bragging rights during the euphoric phases. And to do that consistently, it relies on a tool most equity investors dislike: cash, which is exactly why the next piece of the puzzle makes people even more uncomfortable. Cash is the most misunderstood part of the PPFAS strategy. In a bull market, cash looks like hesitation. It looks like indecision. It looks like a missed opportunity. But that's only true if you believe that market is fair. PPFAS doesn't. The fund holds cash for one simple reason. It refuses to buy businesses at prices that don't offer a margin of safety. When valuations stretch and good opportunities disappear, cash builds up automatically. And it's not because the fund is trying to time the market. but it's because it's unwilling to lower its standards. And this is where the bull run underperformance starts showing up clearly. If 20% of your portfolio is in cash while the rest of the market is fully invested and running hard, you will lag. There's no way around that math. And PPFAS frankly has never tried to hide this reality. But here's the part most investors overlook. That same cash becomes a weapon when market starts correcting. When prices fall and fear replaces confidence, most fully invested funds have no flexibility. They're forced to sit through the drawdowns. PPFAS, on the other hand, gets to act. It deploys cash into businesses it already understands and now are available at much better prices. So, what looks like inactivity in bull run becomes decisiveness in bear markets. PPFAS is willing to accept short term discomfort for long term advantage. It would rather disappoint you slightly when everything feels good than fail you when everything feels bad. This approach requires patience, and it requires patience from everyone, to the fund manager to the investor. And it naturally leads to another consequence. To protect capital and maintain discipline, PPFAS also avoids the very stocks that usually dominate the bull market, which brings us to the next uncomfortable truth. Why does Parag refuses to chase what's working? Every bull market has heroes, high beta stocks, hot sectors, new themes. They move fast and dominate the headlines and pull indices higher. And almost every bull run outperformance story is built on them. And Parag deliberately stays away, not because it doesn't see the returns, but because it understands the risk hiding underneath them. Bull markets, they compress the risk perception. Valuations stop mattering, business quality becomes secondary to price momentum. Stocks don't rise because they are great businesses. They rise because someone else is willing to pay them more. Parag refuses to play that game. Its portfolio is tilted towards businesses with predictable cash flows, durable economics, and reasonable valuations. These companies rarely double overnight. They also rarely collapse overnight. The cost of this discipline shows up clearly in the bull runs. When speculative stocks, small caps, or theme driven sectors lead the rally, PPFAS looks slow. It doesn't own enough of what's flying, and it doesn't rush to add them just to look smart in the short run. But this restraint is exactly what protects investors later. When momentum reverses, the same stocks that powered the bull market returns become the biggest sources of damage. Liquidity dries up, narratives break, and losses accelerate. And Parag chooses boredom over bravado. It would rather own fewer stocks that compound steadily than many stocks that need perfect conditions to survive. That decision makes the fund look conservative in the rising markets. It also makes it resilient when the markets turn. Bull markets reward participation, bear markets punish indiscretion. Parag optimizes for the second reality, not the first. And once you understand that, the next piece fits naturally. Because protecting the downside isn't accidental, it's engineered. And that engineering has a very visible consequence during the bull runs. Here's the part that most investors don't like hearing. You cannot aggressively protect the downside and fully capture the bull market upside at the same time. Those two goals fight each other. Parag chooses a side. The fund is structurally built to fall less when the markets fall. Lower beta, higher quality bias, cash buffers, selective buying. All of this reduces downturns when the fear takes over. But that protection comes with a trade-off. Parag intentionally captures less of the upside but dramatically less of the downside. That imbalance is not a weakness, it's the entire strategy. In simple terms, if the market goes up 100 points, Parag would go up by just 80-85 points. Alternatively, if the market falls 100 points, Parag falls just about 50 to 55 points. When the market rises sharply, the same design that limits losses also limits speed. The fund simply does not move up as fast as the high beta fully invested portfolios. And this is not by accident, it's by design. If a fund captures only part of the upside but a much smaller part of the downside, it can still outperform over a full cycle. In fact, it often does. Think about the recovery math. A portfolio that falls 10% needs just 11% to get back to where it was started. A portfolio that falls 30% needs more than 40%. That gap compounds silently over time. In every strong rally, the fund looked slow, but in every sharp fall, it preserved capital. And over the full cycle, it quietly stayed ahead of most aggressive peers. See the numbers yourself. During the COVID crash, in the first 3 months of 2020, markets fell almost 30%, and Parag Parikh flexi-cap fund, it fell only 21%. In the next 9 months of the year, markets gave about 64% returns and Parag Parikh gave 69%. It did better than the market, but not really great outperformance by any means. But when you zoom out and observe the whole 12 months of 2020, you'll be shocked to know that Parag Parikh gave 33% results versus markets which gave only 15%. So that's almost double that of broader markets. This same thing also reflects in the capture ratios of Parag Parikh. Its up capture ratio is about 80%, which basically means that if the market goes up 100 points, Parag Parikh would only go up by 80 points. And its down capture ratio is 55%, which again means if the market falls by 100 points, Parag Parikh would just fall by 55 points. So if there is a fund whose motto is protect capital before making profit, it's this fund. Parag Parikh focuses obsessively on avoiding deep holes, because once you are in one, no bull market feels strong enough. You're just trying to climb back to zero. And this is why investors often misjudge the fund mid-cycle. They look at one rally and see the lag. They don't look at the crash that didn't hurt as much. They don't account for years not spent recovering. Over long periods, this asymmetry matters more than the annual rankings. Bull market leaders often rotate, but the downside discipline compounds. Parag Parikh accepts being average in the bull markets so it can be exceptional when the markets test patience and psychology. And this behavior doesn't just show up in the domestic stock selection, it also shows up in another area that confuses investors during Indian bull runs. That's global diversification. Because stability rarely looks exciting when everything at home is booming. One more reason why Parag Parikh looks slow in Indian bull runs is something most investors claim to want but rarely appreciate in practice: global diversification. Parag Parikh is one of the very few Indian equity funds that meaningfully invests outside India. But that's not to chase higher returns, but to reduce concentration risk. While Indian markets went through sharp drawdowns, the fund's US holdings acted as a stabilizer. Alphabet alone delivered 30% plus CAGR over long holding periods. They weren't tactical bets, they were long-term ownership of global cash-generating businesses held across market cycles, and these are names like Alphabet, Microsoft, Meta, and Amazon. And this matters more than it seems. Indian bull markets are often narrow: a few sectors, a few stocks, a lot of excitement. When domestic liquidity floods in, India-only portfolios benefit the most. Global markets don't always move in sync. Sometimes they lag, sometimes currencies move the other way. And when that happens, Parag Parikh looks like it's dragging its feet. But this diversification plays a very different role across cycles. When India goes through stress, global holdings can stabilize the portfolio. When the rupee weakens, overseas assets cushion returns. When the domestic valuations become extreme, international exposure reduces dependence on a single market narrative. In other words, global allocation is acting like an insurance. And like all insurance, it feels unnecessary right until the day you need it. Parag Parikh willingly accepts short-term underperformance in India, specific rallies to avoid putting all investors' capital at the mercy of one economy, one cycle, or one valuation regime. That choice doesn't show up well in bull market screenshots. It shows up when cycles turn and portfolios don't crack. Which brings us to the final question investors should be asking. Not why this fund underperforms in bull runs, but what kind of investor it is actually built for. So if you judge Parag Parikh flexi-cap fund only by how it behaves in bull runs, it will always feel underwhelming, because it was really never designed to win the popularity contest during bull market. It was designed to do something far more difficult: protect capital when markets stop being kind. Today, Parag Parikh flexi-cap fund manages about 1.3 lakh crore, which naturally raises the concerns about its large size. Large AUM hurts small cap and high churn strategies, not low turnover, large cap, valuation driven ones. And Parag Parikh's philosophy stays intact even as the execution scales. Another thing to keep in mind is that at an AMC level, no fund house can own more than 10% of the company. So, if a company is worth 1 lakh crore, the AMC across all its schemes can buy only 10,000 crore worth of it. Large AMCs split this across multiple schemes, but Parikh, because it primarily has just one equity fund, all of that 10,000 crore can be allocated to that single scheme. So size doesn't really disadvantage it any more than the larger AMCs already face. Yes, scale might limit chances of repeating those 20% positive returns over the past decade, but within the flexi-cap universe, it remains a very strong and disciplined bet. Parikh accepts that it will lag when liquidity is abundant, valuations are ignored, and risk feels invisible. It does not optimize for excitement, it optimizes for survival, consistency, and long term compounding. That makes it look misunderstood, even boring. But history shows that one simple truth: most long term wealth is not destroyed in bear markets, it is destroyed by decisions made in bull markets. Chasing returns, abandoning discipline, overestimating risk tolerance. Parikh FlexiCap exists to prevent exactly that. If you want a fund that makes you feel smart in every bull market, Parikh might disappoint you. But if you want a fund that helps you stay invested when the markets test your patience, then it quietly delivers. The real question isn't why this fund underperforms in bull runs. The real question is whether you want a fund that shines when things are easy, or one that stands up when things stop being easy. That's it for this video. If you want more such breakdowns, consider subscribing to Bull Luck. Thank you.